Okay, let's get into this. I want you to just imagine for a second, unless you're driving, please don't, but imagine it's January 2026. You're in Davos, Switzerland. It's freezing cold. And the World Economic Forum it's in full swing.
Right. And for the last 3 years, that place was just pure, unadulterated AI hype.
Exactly. Unbridled, almost manic optimism, 23, 24, 25. But this year, January 2026, the whole mood has shifted. It's not pessimistic, not really, but it's heavy. It's complicated.
It's the morning after the big party, you know?
Yeah.
The lights are on, the music stopped, and everyone's sort of looking around wondering who's going to get stuck with the bill.
That is the perfect way to put it. And that's exactly where we find ourselves today. We're sifting through a huge pile of reports, interviews, financial data from early 2026, and they all paint this picture of a market that isn't just cooling down, it's fracturing.
Yeah.
We're calling today's deep dive the Hassabis Doctrine.
Named for Demis Hassabis, the CEO of Google DeepMind. He gave this interview to the Financial Times at Davos, and it completely crystallized this new reality. It's honestly the clearest take on the moment I've seen.
And here's the aha moment right at the top. For months, everyone's been asking this really simple binary question. Is the AI bubble bursting, or is this thing just getting started?
Right. Yes or no?
And Hassabis basically comes out and says, you're asking the wrong question.
It isn't a yes or a no. What he's suggesting, and what all this data suggests, is that the market has bifurcated. It's split right down the middle.
Bifurcated, so two markets now.
Exactly. On one side, you have what we're going to call the paper AI economy.
Okay.
So this is all the hype, the startups, the slide decks, the fragile stuff. And that side, it's in real trouble.
Okay, and the other side?
The other side is the real AI economy. This is industrial. It's about physical infrastructure. It's supply constrained. And that side is absolutely booming.
So our mission today is to give you a roadmap for what these sources are calling the great filter of 2026. We are moving from this indiscriminate funding phase.
Where you could just say AI and get a check.
Yeah, exactly.
Yeah.
And we're moving into the efficiency phase where the actual math has to start working.
And that math is looking pretty brutal for some people and incredibly lucrative for others.
Okay, let's start with the brutal part then, the paper economy. I mean, if you want to understand the absurdity of late 2025, you have to look at this one startup. It was called Human Sands.
Humans ampersand, yeah.
Yeah.
This company is, it's the poster child for the excess Hassabis was talking about.
Just listen to these numbers, they sound made up. Late 2025, this company raises a $480 million seed round.
A seed round. It's just, for context, a $4 billion valuation is normally for a public company, with revenue and customers.
But here's the kicker. Human Sand had, what, maybe 20 employees?
Yeah.
And no product. Nothing. No software, no website you could log into, just a pitch deck.
And this is what we call the talent premium, taken to its absolute logical extreme. Investors weren't buying a business, they were just panic buying tacit knowledge.
Tacit knowledge.
Yeah, the founders were all ex-DeepMind, ex-OpenAI, and the investors just assumed that the know-how to build these giant models was so rare that they'd pay anything to lock it up. They were treating people like, like rare earth minerals.
It's like buying a football team because you have a star quarterback, but you don't have a stadium or a league to play in. You just have the guy.
Precisely. And this is where Hassabis says the bubble is very, very real. Because if the cost of intelligence suddenly drops, and we're definitely going to get to that whole moat of just having smart people, it just evaporates.
So having 20 geniuses isn't worth $4.5 billion anymore.
It might be worth 40 million, but not billions.
A massive haircut. And speaking of evaporating, let's talk about the wrappers. That's another group that's getting absolutely crushed right now.
Right. So a wrapper is basically a startup that puts a pretty user interface on top of a model like GPT-4.
Oh, yeah. I've used these. AI for lawyers, AI for booking travel, that kind of thing.
They were everywhere for a while, but now they're facing an extinction event.
Why? What happened?
Well, the foundation models are becoming agentic.
Agentic. Okay, we hear that word a lot in these sources. Break that down.
It just means the model itself, Gemini, GPT, it's not just a chatbot anymore. It doesn't just give you text. It can actually go do things. It can write the code itself. It can book the flight itself.
So you don't need the middleman anymore.
You don't. If the brain of the AI can do the job end to end, the app that just helps you talk to the brain becomes, useless.
So the data in early 26 shows what? People are just abandoning these apps.
Retention rates have fallen off a cliff. And Series A funding for them has basically frozen solid. The value is all moving to the model, not the interface on top of it.
Okay, that makes sense. But this is where it gets weird. If all these startups are crashing and the unicorns are in trouble, you'd think spending across the industry would be slowing down.
You would absolutely think that. Logic says bubble pops, spending stops.
But it isn't. And this is where we get to the real economy. And to see the truth, you have to stop looking at pitch decks and start looking at a company that doesn't trade on dreams. It trades on silicon wafers. TSMC.
Taiwan Semiconductor. The ultimate truth serum for the tech industry. You can't fake an order for a 3-nanometer fab.
And their Q4 2025 numbers are just staggering. Revenue was, what, $33.7 billion, up 25%. But the number that really made me sit up straight was their CapEx budget for 2026.
It's massive. They're guiding for $52 to $56 billion in new factories and equipment. And you have to understand, TSMC is a super conservative company.
Right. They don't build on spec.
Never. They don't build a factory unless they have orders locked in for years to come. So if they're spending $56 billion, it means they know exactly who's buying those chips in 2027, 2028.
And their CEO, C.C. Wei, he called it a multi-year AI megatrend. He's not seeing a slowdown at all.
He's seeing the opposite, a supply constraint. They literally can't make the chips fast enough.
And we know who's buying them. It's not the startups. It's the big four. Amazon, Microsoft, Google, and Meta. Their combined projected spend for 2026 is $602 billion.
$600 billion. Just let that number sink in. That's bigger than the GDP of most countries. That creates this incredibly high floor for the hardware market. Even if every single startup goes to zero tomorrow, those 4 companies can sustain the whole supply chain by themselves.
They're building the industrial grid for the new economy. It's like the railroads. They don't care if the first few towns along the track go bust. They're just laying the track.
That's the perfect analogy.
Okay.
And they can afford to wait. The startups can't.
There's always a but. When the whole game seemed to be whoever spends the most money wins, something happened in January 2025 that just shattered that whole narrative. The DeepSeek Shock.
Oh, this was a geopolitical earthquake. It completely changed the physics of the market. This was the plot twist nobody saw coming.
DeepSeek R1, a model from a Chinese lab. The headline was that it had performance parity with GPT-4. So, just as smart. But that wasn't the scary part.
No, the scary part was the cost.
Right. Training GPT-4 was estimated at, what, over $100 million?
At least. Some estimates are way higher. DeepSeek trained their model for an estimated $5.5 million.
A 95% discount? How is that even possible? I thought you needed thousands of the absolute best NVIDIA chips, the ones that are banned in China.
That was the whole U.S. strategy. Brute force, just throw more money and more chips at the problem. But China couldn't buy those chips because of export controls. They were stuck with older ones, like the H800.
So they were forced to innovate.
They had to be smarter. They couldn't buy the muscle, so they had to build a better brain. Instead of brute force, they used a different architecture, something called mixture of experts, or MOE.
Okay, let's unpack MOE because this is crucial. Explain it simply.
Okay, so imagine in the old models, every time you asked a question, it was like one super genius librarian had to run up and down every single aisle of a giant library to find the answer. It's thorough, but it takes a ton of energy.
Sounds exhausting.
It is. Mixture of experts is like having a whole team of specialist librarians at the front desk. A biologist, a poet, a coder. When you ask a biology question, only the biologist wakes up. The others stay asleep.
So you're only activating a tiny part of the model for each query.
A tiny fraction, and that saves a colossal amount of energy and compute power.
The irony is just. It's incredible. The U.S. bans the best chips to slow China down, and it forces them to write better code that makes them more efficient than the West.
And that efficiency is deflationary. This is the key. If you can create state-of-the-art intelligence for $5 million, then intelligence is not a scarce luxury good, it's a cheap commodity.
And that $4.5 billion valuation for humans looks even more insane.
It completely destroys the moat. If anyone can build a genius model for the price of a nice apartment, then the model itself isn't where the value is. It's just a utility, like electricity.
So that brings us back to Hassabis. If the models are becoming commodities, who actually wins?
Well, this is why Demis Hassabis is so confident about Google. Alphabet is basically a fortress in this kind of environment.
Because they have their own money printer, the search engine.
They have a sovereign wealth fund. Search ads just print cash, and they use that to fund DeepMind. But the bigger deal is that they're vertically integrated.
Oh, okay, explain why that matters so much right now.
Look at the cost stack for most companies. They rent cloud space from Amazon, they buy chips from NVIDIA, they license a model from OpenAI. Everyone takes a cut.
Right.
Google owns the data centers, they own the model Gemini, and this is the crucial part, they own the chips, their own custom TPUs.
So they don't pay the NVIDIA tax.
Exactly. And that gives them a structurally lower cost base than almost anyone else. If the price of AI services crashes because of this DeepSeek effect, Google can survive. A startup that's renting everything can't.
And they're making a huge play for the next platform, right?
Yeah.
Project Astra.
This is the pivot. Hassabis talked a lot about smart glasses being the perfect form factor for an AI agent. It sees what you see, hears what you hear. It's a direct shot at bypassing the smartphone.
The post-smartphone bet. But let's flip that coin. If Google is safe because they have their own chips, what does that mean for NVIDIA? Their valuation is something like $4.6 trillion. Are they vulnerable?
They are more vulnerable than the stock price suggests, and it comes down to the difference between training and inference.
Okay, break that down.
Training is like going to college. It's intense, you do it once, it's very expensive. That's what NVIDIA's best chips, the H100s, are amazing at. But inference is using that knowledge every day on the job.
Okay.
As the world finishes building these big models, the market shifts from training to inference, from college to the daily grind.
And for the daily grind, you don't need the absolute Ferrari of chips.
You want a Toyota Prius, you want efficiency, low power. And for inference, companies are all switching to custom chips called ASICs. And this is where a company like Broadcom comes in.
Broadcom, the networking guys.
Yep. They are the quiet winner here. They help Google and Meta design these custom inference chips. Broadcom's AI revenue is doubling to over $8 billion a quarter because of this shift. As the world moves to inference, NVIDIA's monopoly power weakens.
Fascinating. So we have the winners and the vulnerable. But there's a much darker cloud here, the financial plumbing of this whole thing. There was a stat about corporate debt that was, frankly, a bit scary.
It's the financial time bomb of this whole cycle. In the last quarter of 2025 alone, tech firms issued $108 billion in bonds.
That is just a staggering amount of borrowed money.
It is, and the problem isn't just the amount of debt, it's what they call a duration mismatch.
What does that mean in plain English?
It means they're taking out 10 or 20-year loans to buy GPUs that will be functionally obsolete in 3 to 4 years.
Oh, wow. That's like taking out a 30-year mortgage to buy a car.
Exactly. It's a car that's going to be a rust bucket before you've even paid off a fraction of the loan. And if those chips don't generate massive immediate cash flow, you're in a trap.
A debt trap.
You'll have to borrow more money in 3 years to buy the next generation of chips, while you're still paying off the debt for the old, useless ones.
That sounds like a Ponzi scheme.
It has echoes of the telecom bubble in 2000. Companies borrowed billions to lay fiber, assuming internet traffic could make them rich. The traffic came, but the prices collapsed. The debt stayed. It's a very similar setup.
So if the DeepSeek effect makes intelligence super cheap, how do you pay off $100 billion in debt?
That is the multi-trillion-dollar question. And right now, the market is not pricing in that risk.
So let's pull all this together. We're at the great filter. What's the big takeaway for someone trying to make sense of all this?
The big takeaway is that the party's over. And now the work begins. We are officially in the show me era. The FOMO, the fear of missing out, is gone. It's been replaced by ROI, return on investment.
No more funding for just a slide deck and a dream.
No. The market is aggressively separating the real AI economy, the infrastructure, the silicon, the big integrated giants from the paper AI economy of productless startups. And you need to know which side of that line you're on.
And before we go, I want to leave everyone with one final kind of provocative thought from the source material. We talked about efficiency, right?
The white-collar recession.
Yeah. There's this paradox. Tech revenues are growing. These companies are more profitable than ever, but they're not hiring like they used to.
We're seeing a jobless recovery in tech.
Because a senior engineer using these new AI tools can do the work of 3, maybe 4 people. So if Hassabis is right, and AI brings radical abundance, what happens to the entry-level job market in the meantime?
It's a serious question. If the AI is now the junior developer or the junior paralegal, where does the next generation of human experts come from?
You're kicking away the bottom rungs of the ladder.
Exactly. The efficiency phase is great for a company's bottom line, but it might be terrible for a computer science grad in 2026. And that's a risk the market hasn't even begun to think about.
Something to chew on. Remember, look past the hype. Look at the physics of it all, the energy, the silicon, and the debt. That's where the real story is unfolding. Thanks for diving in with us.
Anytime.